Back for a pre-election video. This one, we'll go through what happened last week, kind of what the markets are talking about, how the economic data was. Uh, I'll start talking about the structural rise in rates fall. This has been going on for 4 years, but I only started doing videos on YouTube back in August. A lot of the things that I did pre that were videos on rates vol staying at higher levels. Well, I think now we got to start talking about it and also what it means for AI and for Bitcoin. So it was a big week for AI in terms of, I would say, talking about the future and just a lot of continuous flow of data, verbal data on AI, but it's now spreading into the data center side, which has huge capex implications. There was a conference in Riyadh, the FII conference. I listened to a bunch of podcasts, but in particular, some numbers from Masa-san from SoftBank and also Elon Musk. And then it was Bitcoin's birthday, and I'm going to go through, I'm doing a lot more presentations with people on what's happening with Bitcoin and really doing the why. This is I would say, the solution or the offset to the structural forces of debt, demographics, exponential innovation, and the distribution of wealth problems. So just to start, the election has the focus for everyone. We saw kind of a second week of weakness off the all-time highs in the S&P. It coincides with a reduction in where Donald Trump was in terms of the percentage of winning. So it declined for really the last kind of 7 to 10 days. That also reduced the sweep chances for the Republicans. So you had just a change in that, and I think because of the trends that had been on before, that led to just some give back on things. You can see how important the election is, even from the earnings perspective, with companies mentioning it. This is from FactSet, so it's been a part of everyone's conversation at this point. And so until we get through, almost all of the movements to me are related to just profit taking and hedging that's going on leading into the election. The S&P, as I mentioned, down for the second week in a row. The monthly performance, very muted. So last month, we finally got a down month, the second down month in the last 12. And you have, so far this month, on the back of the payroll number and the movement on Friday, a slight up month to start. In terms of the earnings season, so we're at this point 351 through, so we're about 70% of the way through. Right now, the earnings growth for the S&P is over 8%, driven again by the mega cap names. But so far, earnings, doing what they've done. If you break it down by revenues and kind of see what's been above and in line, you start to notice a pattern here. Here, the green is above line, and you see the service side basically here, the S&P here, and then all of the negatives tend to be either on, I would say, the old school consumer thing. So you'd have to take Amazon out of this, but since it's only one name, you get a scenario where brick and mortar is basically suffering. And that's a theme, again, as we get more into AI and more into the service-based economy driving things, you're not having it broaden out. And this goes for small companies too. So the Russell 2000, completely different story. Earnings growth so far, as we're not as much of the way through, but you are at this point about 35-40% through. You've got the Russell down 3% in terms of earnings growth, and in here you even have technology down so far. This disruption from the mega cap names, which is shown here, the chart of the mega cap names versus small cap, just continues. And I've been talking about an expectation that we'll have a bump in inflation and commodities. Part of it, in my opinion, will come from China. There is the NPC party meeting this week. So this week we will get some more details on stimulus. We'll see how the market responds to it. So far, the Chinese markets, I haven't shown them because they've kind of gone sideways since that massive move higher, the pullback the next week. They've just kind of stabilized. We are getting incremental data that things have improved there economically, but until we start seeing a trend that shows up both in the data and in the prices, or it fails, I'm just not going to spend a lot of time on it. The mega cap names just continue to hang near the highs, and more importantly, really they're unchanged since June, and I think this is an important conversation because NVIDIA, which is by far the most important of the names in terms of benefiting, so far we've had the company showing massive revenue, massive CapEx spend, but not seeing the revenue come through. Their earnings are decelerating in terms of the growth side. So NVIDIA becomes more important. And this is the 100-day rate of change, which really just says to me that their earnings announcement, which comes after the election, is going to be important, I think, and probably the inflection point. It comes just before Thanksgiving week. It'll be the data point to me that kind of decides as liquidity drops off, buybacks pick up, and we get through the election. If there's no major surprises, if Trump wins, as the polls suggest, I do think you're going to see the market move higher again. If Harris wins, I think will unwind a lot of these trades. It'll cause some disruptions. But NVIDIA's earnings will be very, very important at this point. In terms of the economic data, the payrolls number, I talked about 2 weeks ago that the hurricanes were going to, and the port strike were going to distort everything in the near term. And that's what we got in terms of the headline payroll numbers. That's one of the reasons why I always say use this aggregate weekly payrolls, which incorporates the jobs hiring and firing, but it also incorporates the hours worked and the hourly earnings. And you can see this was kind of another, continuation of what we've seen. To normalize it, if I take the 3-month average, we're actually at the highest level in the 3-month average since 22. So there's nothing in the payrolls for people who want to be bearish to suggest that anything bad is going on. In terms of where we are GDP now, from Ed Yardeni, currently the GDP now is coming in at the highest level in the last 3 quarters. It's right around where it was at the end of 23. And so we continue just to see GDP is fine in the U.S. This is the momentum of it. So this is it relative. This is the City Surprise Index for the U.S. So the month of October was the best month since 23. So not only have the GDP numbers been coming in, but we're starting to beat at a pace that's higher than what we've seen. And this goes for the G10 as well, which is really the more important story to me, is that the G10, so not just the U.S., but when you go outside, we're seeing strength there. So the economy is fine, and the Fed's cutting rates. So we still have a 97% chance of the Fed cutting by 25 basis points. More importantly, you still have rate cuts in, and you've got 125 basis points into 2026, beginning of 26. So that means for next year, we're ending the year with 50 in. You've got about 75 basis points still built in for cuts next year, despite the fact that the economy's fine, jobs are fine. And what's starting to happen is when you have Druckenmiller and Paul Jones come out and say they won't own bonds, you have the Fed, they believe the Fed made a mistake. But as Paul Jones said, you can't do anything to the budget deficit with cuts on anything when interest payments and the entitlements are basically untouchable because of both voters and because of where we are in rates. They have to move rates lower, and it's at the expense right now of what's happening in long yields. So they make the surprise cut at about 362. We're now at 438. So you're talking about a 75 basis point rise in 10-year rates, which is starting to get attention. These are the basis point weekly moves. So it's been a sharp move higher since the Fed actually cut rates. And I think the more important thing, and this is what I talked about at the beginning, is the structural rise that's happened in rates vol. So the MOVE index, which is measuring rates vol, was up again. This is the 6th week in a row that you've had a rise in rates vol. You have to go back to really before we ended the the hiking cycle back in 22 when people were very scared of inflation at that point. This is not happening, in my opinion, because of inflation. I think this just happens that the Fed cut rates in September. We have the elections staring in front of us. People are buying protection for valid reasons, which is the election creates a lot of uncertainty, especially if there's no decided winner and it leads to when you go through the distribution, it's not surprising that vol's moving higher because the demand's moving higher, and I don't think there's a lot of supply at this time of the year because of the calendar year for the banks. So typically you see a drop off in liquidity in November because people don't want to take any big risk before the end of the year. What is important is the VIX has moved higher as well. So you've got rates vol here, structurally higher. You can see the white line. We've structurally moved into this level since 21. The VIX, on the other hand, structurally, it had got back down to the levels that were consistent in the QE lower rates vol. And more importantly, credit spreads are actually lower than they were during the 2011 to 19. There's less recession risk. I've talked about no recessions. I will stick with that. No recessions. But rates vol is going to be higher. Equity vol will continue to move around, and at periods it will go higher. So the question is, and this is what I write about in my Substack often, there's no free lunches. There has to be something that shows up. But if it's not recession, this is another emphasis that the credit side, even on the stuff that you would use for hedges, this is IGCDX, which has not moved. So credit default swaps are not moving with the MOVE index at this point, which would suggest there's enough protection in. But I do think people have to start focusing on what this means for the stock market. If you're not going to have recessions, well, then theoretically stocks should just continue to move higher. But obviously, we've got higher valuations. We have a higher rates vol, which to me means we're going to have periods where we have large drop-offs. Now, this is something that Goldman Sachs put out this week, which is showing basically a Sharpe ratio on the S&P, so taking the one-year return divided by the one-year realized vol ratio. And it's showing how high it is. And if you went back into these years, 2018, 1997, 95, one thing that stands out is that these were different periods. The Russell 2000 was up about 27% this year. It was up about 20% that year. It was up about 14% this year. So far this year, it's up 9%. And the reason I bring that up is because we are getting less and less participants in this, and I don't see this as the same thing. The downside to all of this is that I think we're going to have more drawdowns in the stock market. So instead of looking for bad moves in the stock market that actually stay in place, there's a couple things that you notice here. These is the max drawdown from peak to trough going back to 1980. This is obviously the 2000 period in terms of the recession. This is the recession here. This is the crash in 80. This is a recession. This is a recession. What I want to highlight is a couple things. First of all, we've had now 3 down 20% within a 6-year period. This was 2018, this was COVID, and this was here. I think we are more vulnerable to 20% corrections than we were before. In this case, you get a 20% correction, but then it takes a long time to get back to the all-time highs. That's what the width of this is. Even in COVID, we got back to all-time highs fairly quickly. Back here, and this is in the, I would say, the boom time of the internet, we didn't get many, and this is what I think is going to be the opposite of this. I think we're going to have a period where we're going to have more of these. The drawdowns will be bigger, and we will get more of them, but they're not going to be because of recessions. And that's one of the reasons why, as you go through this, with rates vol at higher level, it's being driven by the fact that before 2008, in 2007, the U.S. had $9 trillion of debt. Now we have $35 trillion of public debt and growing from the government level. So we took the banks and consumers' debt, a lot of it, onto the public balance sheet. And then we had COVID, which expanded it again. So I've talked about how AI and in particular Bitcoin are now the forces that are lined up with what I said at the beginning, which is we have structural debt. We have a demographic issue. The first baby boomer retired in 2011, and the entitlements are driving that debt. At the same point, we have exponential innovation. So the iPhone came out in 2007, but Bitcoin white paper, which gets into the ability of having digital uniqueness, that came out in 2008, just after Lehman. and we've got the distribution of wealth problem, which is in there. So AI is the most important factor for the stock market at this point because it is the growth side. And so getting into this FII, I mentioned that Masa-san spoke. So if you go listen to the video of his interview, what you'll see is he's talking about, first of all, having super intelligence to exist by 2035. I won't go through that, but if you listen to him, if you listen to Elon Musk, who also spoke at it, Elon Musk, by 2040, we'll have more robots than we will humans on the planet. We'll have been to Mars multiple times. There's a lot of things that you just need to kind of enter into your mind that when you're thinking about the economy and you're talking about things like recessions, what's going on at the same time, if you're not following it, is AI is accelerating at a pace that dramatically is faster than what happened with the smartphone. And so you're talking about a need for an enormous amount of capital expenditure. This is from Masa-san again. I just want you to have this number in perspective. Gen AI will require $9 trillion in cumulative capital expenditure for data and chips in the future. So NVIDIA, he's saying, and basically saying, it's undervalued because the future is much bigger. If you read that line, undervalued because the future is much bigger, this is the way you have to think about everything in there. If you're investing in the Russell 2000, can those companies benefit from a world where AI is growing rapidly at a rapid pace? And the answer is, at this point, it doesn't look like it. I don't think it will. I think it'll be private companies that benefit from AI, not public small companies that have never had massive budgets into tech. I just don't see where they're going to be able to see the benefits. And so what you're dealing with is a digital world which is accelerating. The money is funneling into more private companies, but not kind of the VC, make an investment go, but just a mega amount of smaller companies that will benefit from AI. But that's going to take a while to compete. In the meantime, this is a mega cap world, so it's very concentrated. I'm just going to quickly go through some other places in AI. There's a lot of manifestos, so if you don't want to listen to the interviews, this one was a story from the Anthropic CEO, just talking about the way, when you say manifestos, what AI will look like. You have to spend time on what the future is going to look like to get a sense as to the investments. It's moving at that kind of speed. It's not just him flooding the tech zone. My Substack, I try to keep up as much as I can with providing podcast and interviews. So if you haven't gone to my Substack, I would go there. I do that weekly as well, and that's in a written form. You can obviously listen to it there. But I try to highlight a lot of the components that are moving at the same time, in particular, the bridge to change, which is what I'm calling Bitcoin now. Elon Musk this year built the world largest AI supercomputer, and it's called Colossus. And this week he announced that it's going to be double the size soon. Just again to highlight how fast things are going. Bloomberg came out and said now 2025 capex may hit $200 billion. So if you're looking for GDP to slow down, just remember these dollars are not stopping, and they're not coming from borrowing. They're actually coming from cash and from people that have already raised the money. This is really important. If you haven't heard, this was a podcast, Gavin Baker, I think it's Invest Like the Best, Patrick O'Shaughnessy, great interview, but he talked about how these companies realize that they're racing to create a digital god, which theoretically would mean winning the battle and winning all of the revenues to have a digital god or a super intelligent ability to compete with anything, create companies, everything. So from a competition, and to give you an idea, this was within the last week, the White House released a memorandum. The reason I wanted to include this in there, you want to have things where the money's there, where the government is supporting it, and where they're basically realizing this is national security. The investments are going to keep coming in the AI world. So if you're trying to fade it, if you're trying to be on the other side of it, I think you're going to have a hard time going against the government, the amount of capital that's sitting out there. We will have stock market corrections. They will, in my opinion, be large at times, like they were during the summer of this year. That was only a 10% one. But I do think we'll get 15 to 20% ones. The question is, will they bounce back quickly? And I think they will. We're now starting to move into the data center side, the the Substack I did this week was that I believe we're going to start to see oil and copper move higher. It's a contrarian type view based on where these things are right now. And the main reason is because of the numbers that are staggering on how much power we're going to need. KKR this week sees 250 billion spent annually from data center boom. So just remember what I talked about in terms of the AI capex. Separate this and add another whatever you want to it. The data center numbers are going to be enormous as well, and KKR got involved in or confirmed it this week. Just more, another article, if you guys go out there and you want to find these articles, this came out this week, really focusing a lot on the data center side. You had the government come out in terms of the Federal Energy Regulatory Commission, basically saying how important this is again when we're needing to race to AI. You have to remember, think of AI as a nuclear race, no different. AI is basically key to being strong from a military basis going forward. So the government's going to continue to focus on it, which means they're not going to regulate it in a way that's going to slow down the ability of going, or they're going to be in a very difficult position to do it. This is McKinsey coming out and just showing how staggering the numbers are. You want to invest in things. It's very hard to find things that can show a CAGR of 20+% on the low range scenario, and these numbers just get bigger. So the data center side, if you haven't spent the time doing work, and how it fits into the power, but also how it's going to fit into customers and inflation. So this is already starting to happen. This is from the Washington Post recently, where because of the strain on the power grid, you have one of the biggest data center areas in Virginia, you're starting to see bills rise for everyday customers. Power and energy may not mean crude to start, but I remember in China in the 2007 period in particular, I traveled the first time to China in early 2008 to go, because I was long commodities, long emerging markets, short a lot of things in the US. And I was trying to figure out how much this China thing on energy with crude headed towards 150 was real. And what I saw was that oil was being moved higher predominantly because coal, which is what they were doing more, they were running into issues on being able to get coal. There were bottlenecks. I think as we get into the next couple of years, the data center side and the power that's needed, the electricity that's needed will become an issue. Bitcoin is connected to this. So if you're looking for another angle as to why Bitcoin mining, they had data centers long before the AI stuff became a major demand. So you have a lot of miners that are out there in a lot of places across the globe, particularly EM countries that have already been doing Bitcoin mining. I'm going to show something on Argentina at the very end. This is a connection. So the power needs that go for AI also fit in with the Bitcoin side and the miners. So just keep that in the back of your mind. And I'm going to finish up here with the last 7 or 8 slides, all on Bitcoin. It was the birthday. So again, October 31st, 2008, the Bitcoin white paper was written. Just so you have it from an innovation side, the blockchain, the ability to tokenize assets, meaning the ability to have all of the real world assets on the blockchain. It was an important innovation day. The asset itself has obviously gone up dramatically. People question it because it's not a payment. I don't view it as a currency, and I'm going to keep saying that this is a digital asset. This is the S&P 500 of the digital world, the way it's going to look, the way that your kids understand it, and the way that people above the age of 50 can understand it because they're thinking in companies, they're thinking it in things. That's not the way I think about it. It's just an asset. It is like digital gold, but more importantly to me, it's actually more than that. It is the innovation of the future. As the innovation grows and as more digital wallets are there, Bitcoin will get a percentage of that growth, just like the S&P has. And remember, the reason the S&P is 70, or the U.S. technology companies are about 73% of MSCI World, is because the U.S. has dominated in innovation. So these companies that make up here, these are the assets by market capitalization. Bitcoin is the 10th biggest, yet almost everyone in the U.S. owns Meta and Amazon and Apple and Microsoft and NVIDIA and Apple. But still, there's a tremendous amount of people that do not own Bitcoin. It should be a percentage of your portfolio. These are the largest assets. It should pass Meta very soon after the election, because I think Bitcoin will benefit significantly. And then you're just going to continue to move up the ladder. But if something has that much asset creation already in terms of growth, it is something that should be in people's portfolios. I want to just kind of lean on this Paul Jones thing again from last week and said we are going to be broke. And again, this is why Bitcoin is so important, because we've basically taken the capitalist system to a place where there's just no turning around. We have 35 trillion in public debt in the US. It was 9 trillion before the Bitcoin paper and before the great financial crisis and before QE. Once we realized that we never have to have this and software started, we've been able to offset a lot of the inflation with a slowdown in China, not needing commodities as much as they were, but also with technology to keep the service side a little bit in check. Those balancing acts just allow us to keep printing more and more money without having the stock market fall or without having hyperinflation. So there's a book that was written, and Lynn Alden is someone I listened to. I've probably listened to her speak more in the last year than any other macro person. I try to listen to her every week because she does a lot of interviews. She wrote a book called Broken Money. If you want to spend time just listening to one person who connects the fiat world and has a very good understanding of the history of economics, but also this why she believes in Bitcoin, why it is not a solution, but it is an offset that will continue to get more in there. This is a good book to kind of brings it all together. What she does talk about in a lot of the reports she does is just, how global liquidity. So think of it as what I talked about. There's 35 trillion. We have to keep printing money. It's what Paul Jones talked about. It's what Stan talked about. There's just no way to get it in check. Bitcoin has the highest alignment with global liquidity, but the S&P is number 2. So when people own the S&P and they don't own Bitcoin, but Bitcoin is going higher much faster than the S&P is, never do I say you shouldn't have some of this, but over time, this is getting more money than this, in my opinion. And even if you believe that it's only a 5% chance that this will end up being the dominant asset going forward, then put 5% in. There's some percentage that you should have in your mind as to where it should be. Here's the linkage. So global M2 is the white line. This is taking the M2 of Europe, the US, and China, since that's the bulk of it. It's in dollar terms, so whenever the dollar weakens, it tends to go up higher. And then the orange line here is Bitcoin. I smoothed it, so this is the 200-day moving average. I smoothed it because you get a lot more moves because of the volatility relative to money supply, which is slow, and the S&P. And then the yellow line here is the S&P. You can see the linkage. It's directly related to it, and it is all-time highs. Now, I mentioned tokenized funds. I'm going to start opening this up, because tokenization is one of the most important components that the Bitcoin paper opened up by being able to use the blockchain. So this is from BCG, so Boston Consulting Group, basically put out a statement, a press release this week, the third revolution in asset management decoded. They're basically talking about having 600 billion by 2030, and this is in mutual funds that have gone to tokenization. So this is going to be something new for people to show that this is not like some guess by Boston Consulting Group. You have McKinsey also talking about this. They had a number of 400 billion. This is in trillion. This was a little while ago, but they were seeing $2 trillion into it. Every dollar that goes into tokens. So a token will be stable coins, a token will be NFTs, but it'll also be real world assets. And that's specifically what we're getting into now, is how do we move real world assets, things that you guys own right now, into tokens. McKinsey's basically bringing it up that it is going to, by 2030, be there. If you want to read a report on it in terms of real world assets, the way to benefit from this is Bitcoin again. Money will flow into the blockchain. Some of that money, once there's digital wallets, will flow into Bitcoin. It's digital gold inside this new universe. These are all the real world assets that you have in your portfolio: real estate, cash, commodities, equities, money funds. We're gradually putting this on the blockchain. It does a lot of different things. BlackRock has talked about this as a $10 trillion tokenization vision of real world assets. They have started this month, or in October, using tokens as collateral. So again, moving closer, think of mainstream as just usage. I did the Stripe purchasing of bridge last week, which is going to open the payment side on a global basis. The reason the global basis matters, the benefits are the countries as they're going through de-dollarization. They don't want to be stuck, particularly the BRICS nations, in a world like Russia where they're too dependent on the dollar. BRICS nations to adopt Bitcoin for global trade. Again, someone from Van Eck is very big with inside the crypto space. So although they are talking their own book, I think they're also talking from a perspective of really being involved and knowing what's happening. Finally, the final two things from this week: Bitcoin mining takes center stage at Argentina's central bank. You should go read this. They put up an exhibition at their central bank titled Art, Artificial Intelligence, and the Future of the Economy. They are mining Bitcoin there. They show the Bitcoin mining machines. But this is the first central bank to really do this, and this is in the Malay presidency. So Argentina is making a big shift, and crypto is a big part of it. You're going to see this. This is part of the distribution of wealth for countries that are not able to benefit from what's happening right now with the AI move. They are trying to find a way to have a more stable environment, and Argentina is just another place. Just to finish up, Michael Saylor, I mentioned him a lot on these. This week for MicroStrategy, he announced a $42 billion capital raise, with $21 billion coming from an equity offering of MicroStrategy, and then a target of raising another $21 billion in fixed income securities and buying Bitcoin with that money. So he's obviously done extremely well. The company's gone dramatically higher. I think people are still skeptical on it. I will keep trying to help you guys bridge the fiat world, the macro situation, what's happening in there, back over to Bitcoin. That's it for this week. Go to the Substack page where I'm going to be doing a lot more on this. I'll also be doing a special Bitcoin report, hopefully in the very near future. Thanks. Have a good one.